In March 2022, something remarkable happened that barely anyone noticed at the time. While Western media celebrated Russia's ejection from the global banking system, central banks across Asia, the Middle East, and Latin America were making phone calls, not to Washington or Brussels, to Beijing. They were asking a single question: how do we protect ourselves from becoming the next Russia? That question, asked simultaneously by dozens of finance ministers and central bank governors, marked the exact moment when American financial dominance began its terminal decline, because what the United States thought was its most powerful weapon turned out to be a suicide vest. And it's not the first time this has happened. It's actually the third time in modern history that a global financial hegemon has destroyed itself by weaponizing the very system that gave it power. Each time, the pattern is identical. Each time, the dominant nation believes it's invincible. Before we dive deeper into this story, I'm glad you're here on Finance Folder. If you want to understand the forces reshaping global finance and what it means for your money, hit that subscribe button and drop a like on this video. We break down the financial stories that actually matter, not the noise that fills financial media. Now, let me take you back to understand what really happened and why the consequences are irreversible. The SWIFT system, for those who don't fully understand it, isn't actually a bank, and it doesn't move money. SWIFT is essentially a secure messaging service connecting over 11,000 financial institutions in more than 200 countries. Think of it as the text messaging system for banks. When Deutsche Bank in Frankfurt needs to send payment instructions to JP Morgan in New York, SWIFT carries that message. The actual funds move through correspondent banking relationships. But without SWIFT's messaging infrastructure, modern international banking simply stops functioning. The system handles roughly 45 million messages every single day, representing trillions of dollars in global commerce. Oil shipments from Saudi Arabia to China, aircraft purchases from Boeing by Singapore Airlines, bond transactions between Tokyo and London, pharmaceutical imports from Switzerland to Brazil, all of it flows through SWIFT messages. The system was established in 1973 by European banks who were tired of using outdated telex systems that were slow, insecure, and error-prone. SWIFT revolutionized international finance by creating standardized message formats and security protocols. By the 1990s, it had become completely indispensable to global trade. Here's what makes SWIFT particularly powerful as a geopolitical tool. The organization is technically headquartered in Belgium and governed by representatives from member banks worldwide, giving it an appearance of neutrality. But appearances deceive. The reality is that SWIFT operates in a dollar-denominated world where the majority of international transactions ultimately clear through American banks in New York. This gives the United States Treasury Department enormous leverage. If the U.S. government decides that a particular bank or country should be excluded from SWIFT, it can pressure the organization through various legal and financial mechanisms. The threat is simple: cooperate with U.S. sanctions or lose access to dollar clearing, which would be catastrophic for SWIFT itself. So while SWIFT maintains the fiction of independence, it effectively functions as an extension of American financial power. For decades, this arrangement worked beautifully for Washington. The dollar's role as the global reserve currency, combined with SWIFT's messaging monopoly, created an unbreakable system of American financial hegemony. The first major use of SWIFT as a weapon came in 2012 when the Obama administration pressured the organization to disconnect multiple Iranian banks. The goal was forcing Iran to abandon its nuclear program by making international commerce impossible. The results were devastating for Tehran. Iranian oil exports, which had been running at about 2.5 million barrels per day, collapsed to barely 1 million. The country's economy contracted by nearly 9% in a single year. Inflation exploded past 40%. The Iranian rial lost more than half its value. Ordinary Iranians faced shortages of food, medicine, and basic goods because importers couldn't receive payment. The sanctions achieved their objective, forcing Iran to the negotiating table and ultimately producing the 2015 nuclear agreement. From Washington's perspective, the SWIFT weapon had worked perfectly. It delivered crippling economic damage without firing a single shot. The success seemed to validate SWIFT disconnection as the ultimate tool of economic statecraft. But something important was happening beneath the surface that American policymakers failed to notice. Iran, despite its economic pain, was learning to survive without SWIFT. The country established workarounds: barter arrangements with trading partners, cryptocurrency channels for some transactions, networks of exchange houses in Dubai and Turkey that could move money through unofficial channels. When the Trump administration reimposed sanctions in 2018, Iran's economy certainly suffered, but it didn't collapse the way it had in 2012. Why? Because Iran had spent 6 years building alternative systems. The country had reduced its dependency on SWIFT and the dollar. It had created economic relationships that didn't require Western financial infrastructure. The lesson was clear to anyone paying attention. SWIFT disconnection is devastating the first time. But if you give a country time to adapt, the weapon loses effectiveness. This should have been a warning signal. Instead, Washington interpreted Iran's experience as confirmation that SWIFT sanctions work, completely missing that each use of the weapon teaches other countries how to defend against it. Then came February 24, 2022. Russian forces invaded Ukraine in what Moscow called a special military operation. Within 48 hours, the United States and European Union announced unprecedented financial sanctions. Multiple major Russian banks would be cut off from SWIFT immediately. More significantly, roughly $300 billion in Russian central bank reserves held in Western financial institutions would be frozen. This wasn't calibrated pressure like the 2014 Crimea sanctions. This was total financial warfare against the world's 11th largest economy, a nuclear power, and a major energy exporter. The immediate reaction in Moscow was panic. The ruble crashed, losing 30% of its value in 2 days. The Russian stock market was shut down to prevent total collapse. Russians lined up at ATMs to withdraw cash before banks ran dry. Western leaders and media outlets proclaimed victory. The Russian economy would implode within months. Putin's government would fall. The war would end. It seemed like the perfect demonstration of American financial supremacy, except none of that happened. Within weeks, Russia's central bank had stabilized the ruble by hiking interest rates to 20% and requiring European countries to pay for Russian gas in rubles, creating artificial demand for the currency. By late spring, the ruble had recovered all its losses and was actually stronger than before the war. Russian oil continued flowing to global markets, just through different channels. India, which had previously bought almost no Russian oil, suddenly became one of the largest purchasers, paying in rupees and reselling refined products to Europe. China increased its Russian energy imports dramatically, settling trades in yuan. Middle Eastern countries served as intermediaries for Russian commerce. Turkey became a hub for Russian financial transactions. By the end of 2022, Russia's economy had contracted by only 2%, far less than the predicted collapse. In 2023, Russian GDP actually grew by 3.6%, faster than Germany or the United Kingdom. Russia had survived what was supposed to be an unsurvivable financial attack. But here's what makes this moment so historically significant. The problem wasn't that sanctions failed to destroy Russia, though that certainly surprised Western policymakers. The real problem was what every other country in the world learned by watching Russia's experience. If you're a finance minister in Riyadh or New Delhi or Brasilia, you watched the United States freeze $300 billion with essentially a phone call and a press conference. That money didn't belong to Russian oligarchs or criminal enterprises. It belonged to Russia's central bank, the monetary reserves of a sovereign nation, and it was confiscated without any legal process beyond an executive order. The message received by every non-Western government was unmistakable. Your reserves aren't safe in the dollar system. Your access to SWIFT can be revoked at any time. Your monetary sovereignty is conditional on Washington's approval of your foreign policy. This created an existential crisis for dozens of countries. Not countries at war with America, not rogue states, but normal nations with their own interests that might sometimes diverge from U.S. preferences. What happens if we have a territorial dispute with a neighbor that America cares about? What if we make an energy deal that Washington dislikes? What if we refuse to support American military action somewhere in the world? Could our reserves be frozen? Could we be cut off from SWIFT? The Russian precedent answered those questions. Yes, absolutely. And with no warning, this brings us to the crucial pattern that keeps repeating throughout financial history. When a dominant power weaponizes the financial infrastructure that underpins its hegemony, it triggers a predictable sequence of events that ultimately destroys that hegemony. The pattern has 3 distinct phases, and we can observe it clearly in previous episodes of financial weaponization. Phase 1 is monopoly and trust. The hegemon controls the global financial system. Other countries use that system because it's efficient, reliable, and seemingly neutral. The pound sterling in 1914, the dollar in 1979, SWIFT and dollar reserves in 2022. Everyone uses the system because it works and because there's no alternative. Trust is implicit. The system appears permanent. Phase 2 is weaponization and shock. The hegemon faces a crisis, usually geopolitical conflict or terrorism, and decides to use financial infrastructure as a weapon. Assets are frozen. Countries are disconnected from payment systems. The immediate effect is devastating for the target, but it also sends shockwaves through every other country participating in the system. The moment Britain seized German assets in 1914, neutral countries realized British banks weren't safe. The moment America froze Iranian assets in 1979, oil exporters understood dollar reserves could vanish overnight. The moment Russia lost access to SWIFT in 2022, every emerging market government knew they were vulnerable. The weaponization destroys trust instantly and permanently. Phase 3 is diversification and decline. This is the critical phase where the hegemon's power actually collapses, though it happens gradually enough that it's easy to miss. Countries that witness the weaponization begin building alternatives. Not just the target country, but neutral nations that fear becoming future targets. They diversify their reserve holdings away from the hegemon's currency. They establish alternative payment systems. They negotiate bilateral currency arrangements. They accumulate gold. The process starts slowly but accelerates as the alternatives become viable. And here's the devastating part for the hegemon. Once the diversification begins, it becomes self-reinforcing. As countries move away from the dollar's network effects weaken. As SWIFT alternatives gain users, SWIFT's monopoly erodes. The weapon that seemed so powerful actually destroyed the foundation of the hegemon's financial dominance. You can't force countries to use your currency and your payment systems. They use them voluntarily because of the benefits. Once you've demonstrated that, you'll weaponize those systems against political opponents. You've eliminated the voluntary participation. Countries now have a powerful incentive to leave, and that incentive overrides the convenience of staying. Let me show you how this played out before, because the pattern is remarkably consistent. In August 1914, Britain was the unquestioned financial superpower of the world. The British pound was the global reserve currency, accounting for roughly 65% of international reserves. The City of London was the center of world finance. British banks financed global trade. The pound was as dominant in 1914 as the dollar is today. When World War I began, Britain passed legislation allowing the government to seize assets belonging to enemy nationals. German businesses throughout the British Empire found their bank accounts frozen, their property confiscated, their contracts nullified. Britain believed this would cripple Germany's war effort while demonstrating British financial power. The immediate impact on Germany was indeed severe, but neutral countries, especially in South America and Asia, drew a different conclusion. If Britain could seize German assets during a war, what would prevent similar seizures in future conflicts? What if Britain had a dispute with their government? Would their reserves be safe in London? After World War I ended, these neutral countries quietly began diversifying their reserves. They increased gold holdings, they established banking relationships in New York, Paris, and other financial centers. They reduced their dependence on London. The United States was the primary beneficiary. New York banks gained business that previously went automatically to London. American gold reserves grew rapidly as countries bought dollars instead of pounds. By the early 1920s, New York had emerged as a rival to London as a financial center. By the 1930s, during the Great Depression, the pound's weakness became obvious. By 1944, when Allied powers met at Bretton Woods to design the post-war financial system, the dollar formally replaced the pound as the world's reserve currency. Britain had gone from complete dominance to secondary status in exactly 30 years. The weaponization of finance in 1914 started a process that ended with Britain's financial irrelevance by 1944. British policymakers in 1914 would have laughed at the suggestion that the pound could lose reserve status within a generation. Yet that's precisely what happened, triggered by their decision to weaponize the financial system they controlled. The American experience follows the same pattern, just compressed into a shorter time frame because modern technology accelerates everything. In November 1979, Iranian revolutionaries seized the American embassy in Tehran and took American diplomats hostage. President Carter responded by freezing all Iranian assets in U.S. banks, approximately $12 billion. This was the largest asset freeze in history at that time. The justification seemed clear and compelling. Iran had violated international law. Americans were being held hostage. Economic pressure would force Iran to release them, and tactically, the freeze worked. Combined with other pressures, it contributed to the hostages' release in January 1981. But strategically, the freeze created a massive problem that took decades to fully materialize. Every oil-exporting country, particularly in the Persian Gulf, suddenly understood that their dollar reserves weren't truly theirs. The money sat in banks in New York, subject to American law and American political decisions. If the U.S. president decided your government was problematic, your reserves could disappear. Throughout the 1980s, OPEC nations systematically reduced their dollar exposure. They diversified into German marks, Japanese yen, Swiss francs, and gold. They spread their reserves across multiple financial centers. Instead of concentrating them in New York, they reduced U.S. Treasury holdings. The dollar's share of global reserves began a long, slow decline that continues to this day. The 2014 sanctions on Russia after Crimea's annexation marked another escalation. The Obama administration imposed targeted sanctions on Russian officials and some banks, but stopped short of full SWIFT disconnection. This was supposed to be calibrated pressure, enough to signal disapproval without forcing Russia into alternative systems. In retrospect, this was the worst possible approach. It gave Russia 8 years of warning. From 2014 to 2022, Russia systematically prepared for financial isolation. Russian holdings of U.S. Treasury securities dropped from $130 billion to essentially zero. Russian gold reserves more than doubled, reaching 2,300 tons. Russia developed SPFS, its domestic alternative to SWIFT. Russia negotiated arrangements with China, India, and other partners to settle trade in local currencies instead of dollars. Putin explicitly stated in multiple speeches that Russia was reducing dollar dependency because he viewed the dollar as a weapon. Western analysts dismissed this as bluster, assuming Russia was too integrated into the global economy to truly decouple. This was a catastrophic misreading. Russia was completely serious, and when the 2022 sanctions arrived, Russia was ready. Now we're seeing the third phase play out in real time, and the data is absolutely unambiguous. De-dollarization isn't a future risk, it's happening right now at an accelerating pace. Let me walk you through the evidence. The dollar's share of global central bank reserves has declined from 71% in 1999 to approximately 58% today. That represents a 13 percentage point drop over 25 years. But the decline is accelerating. In just the past 3 years since the Russia sanctions, the dollar has lost nearly 4 percentage points of reserve share. If this pace continues, we'll see the dollar drop below 50% of global reserves within a decade. More importantly, the dollar's role in international trade settlement is collapsing even faster than its reserve share. In 2021, roughly 73% of global trade was invoiced and settled in dollars. By late 2024, that figure had fallen to approximately 58%. That's a 15 percentage point decline in just 3 years. The fastest de-dollarization in recorded history. Russia's trade data tells the story clearly. Before sanctions, about 87% of Russian international trade was settled in dollars or euros. Today, less than 60% uses Western currencies. That means 40% of Russian trade now happens in yuan, rubles, rupees, dirhams, and other alternatives. Russia-China bilateral trade reached $240 billion in 2023, conducted almost entirely in yuan and rubles. Russian-India trade hit $65 billion, largely in rupees. Russia proved definitively that a major economy can function outside the dollar SWIFT system. That demonstration effect is enormously important because it showed other countries that alternatives actually work. China's cross-border interbank payment system, CIPS, is scaling exponentially. In 2020, CIPS processed about $12 trillion in payments for the full year. By 2023, that figure had more than doubled to $27 trillion. The system now connects over 1,400 financial institutions across 110 countries. It processes transactions in yuan, providing a direct alternative to dollar SWIFT transactions. The growth rate is stunning, 50% year over year, while SWIFT's growth has essentially stalled. CIPS is nowhere near SWIFT's total volume yet, but the trajectory is clear. Within 10 years, CIPS could be handling similar volumes to SWIFT. Central banks are buying gold at rates not seen in 50 years. In 2022, central banks purchased 1,136 tons of gold. In 2023, 1,037 tons. In 2024, over 1,000 tons again. 3 consecutive years of 1,000-plus ton purchases. The last time we saw sustained buying at this level was the 1970s, right before the collapse of the Bretton Woods system and the end of dollar-gold convertibility. Who's buying? China, Russia, Turkey, India, Poland, Singapore, Czech Republic, and dozens of others. They're converting dollar reserves into gold because gold cannot be frozen by executive order. Gold has no counterparty risk. Gold is the ultimate neutral reserve asset. This massive accumulation represents a direct vote of no confidence in the dollar system. Bilateral currency arrangements are proliferating. China has currency swap agreements with over 40 countries worth approximately $500 billion total. These swaps allow countries to settle trade in local currencies without needing dollars as an intermediary. Russia maintains swap lines with China, India, and Iran. India has arrangements with UAE, Japan, and others. The ASEAN nations are developing frameworks for settling regional trade in local currencies. Brazil and Argentina have been negotiating a common currency for bilateral trade. Each of these arrangements represents trade volume that no longer requires dollars. The network effects that made the dollar indispensable are being systematically dismantled. The petrodollar system, which has been fundamental to dollar dominance for 50 years, is breaking down. Since the 1970s, oil has been almost exclusively priced and traded in dollars worldwide. This created structural dollar demand because every country needed dollars to buy energy. But that monopoly has ended. Saudi Arabia, America's closest Middle Eastern ally, announced in 2023 that it would accept yuan for oil sales to China. This broke the 50-year petrodollar monopoly for the first time. Russia sells oil to India in rupees and to China in yuan. The UAE accepts dirhams and yuan for energy sales. Iran trades with China entirely in yuan. Iraq is negotiating yuan acceptance. The petrodollar isn't dead, but it's no longer a monopoly. And once a monopoly breaks, the advantages disappear rapidly. Countries no longer need to hold large dollar reserves for energy purchases. The structural demand supporting the dollar is evaporating. BRICS expansion represents the clearest signal of a shifting world order. BRICS began as an informal grouping of 5 large emerging economies: Brazil, Russia, India, China, and South Africa. In 2024, the bloc expanded to 9 members, adding Saudi Arabia, UAE, Iran, Egypt, and Ethiopia. Over 30 additional countries have expressed interest in joining. These 9 current members represent 45% of global population, 36% of global GDP measured by purchasing power parity, and 42% of global oil production. At the 2023 BRICS Summit in Johannesburg, members announced development of a BRICS common currency backed by a basket of commodities including gold, oil, and rare earth elements. Implementation remains uncertain, but the signal is unmistakable. The largest non-Western economies are coordinating to build alternatives to dollar dominance. Even if a common BRICS currency never fully materializes, the members are already settling increasing amounts of trade in local currencies, bypassing the dollar entirely. Even American allies are quietly hedging. The European Union created Instex, an alternative payment mechanism initially designed to trade with Iran while avoiding U.S. sanctions. Though Instex has processed minimal volume, its existence demonstrates that even Europe recognizes the need for dollar independence. Japan and South Korea have increased yuan holdings in their reserves. Gulf states are diversifying away from pure dollar pegs. These countries remain military allies of the United States, but they're taking financial insurance against American weaponization. So what does all this mean for the future? Let me give you the timeline based on historical precedent and current acceleration rates. When Britain weaponized finance in 1914, it lost reserve currency status by 1944, 30 years later. But Britain was also fighting two devastating world wars that destroyed its economy beyond just the financial weaponization. The United States isn't fighting world wars, and still has the world's largest economy. That suggests the decline might be slower than Britain's. However, modern technology changes everything. In 1914, building alternative payment systems required decades of infrastructure development. In 2024, digital payment platforms can scale exponentially. SIPS doubled its volume in 3 years. That suggests the decline might be faster than Britain's. My assessment based on the data is that the dollar will lose its dominant reserve currency status within 15 to 25 years from the 2022 weaponization. That puts us somewhere between 2037 and 2047. The dollar won't disappear entirely as a reserve currency, but it will no longer be dominant. We're heading toward a multipolar currency world. By 2040, the dollar might represent 35 to 40% of global reserves. Still the largest single currency, but no longer hegemonic. The euro might be 25%, the yuan 22-25%, with gold and other currencies making up the remainder. This isn't speculation, it's extrapolation from current trends. The dollar has lost 13 percentage points of reserve share over the past 25 years. If that pace merely continues without accelerating, we hit 45% by 2049. But the pace is accelerating. The last 3 years saw a 4 percentage point drop. If that acceleration continues, we reach 45% by the mid-2030s. Here's what this decline means in practical terms. Right now, the United States can run essentially unlimited budget deficits because foreign governments need to buy U.S. Treasury securities to acquire dollars for trade and reserves. This allows Washington to borrow $2 trillion per year at relatively low interest rates. The U.S. effectively exports its inflation to the rest of the world through dollar dominance. When the dollar falls below 40% of reserves, this exorbitant privilege disappears. Foreign demand for Treasury securities collapses. U.S. interest rates spike to attract buyers. Budget deficits become unsustainable without triggering inflation. The American government will be forced to make choices it hasn't faced in decades. Either dramatically cut spending, raise taxes significantly, or accept high inflation. The American standard of living, which has been subsidized by dollar dominance for 75 years, will decline. Americans import far more than they export, running an $800 billion trade deficit annually. This is only sustainable because foreigners accept dollars in payment. When they don't, the U.S. must either export more or import less. That means fewer goods available domestically, higher prices, and lower real incomes. The typical American household accustomed to cheap imports from China, inexpensive foreign oil, and affordable goods from around the world will face price increases of 20 to 30% over the next decade. As the dollar loses its privileged position, who benefits from this transformation? China is the obvious winner. China has the second largest economy, the largest manufacturing sector, the largest trade volume, and increasingly a reserve currency in the yuan. As dollar dominance fades, yuan usage rises automatically. China doesn't need to militarily defeat the United States. China simply needs to be patient while American policy destroys dollar hegemony. SIPS is becoming the alternative to SWIFT. The yuan is becoming a reserve currency. Chinese technology companies provide payment infrastructure that rivals Western systems. China holds massive gold reserves to back the yuan. As the multipolar currency world emerges, China stands ready as the alternative to America. Russia wins strategically despite its smaller economy. Russia demonstrated that a major nation can survive complete financial disconnection from the West. This demonstration effect is invaluable because it destroys the myth of American financial omnipotence. Every country that feared us financial power now knows survival is possible. Russia has also strengthened ties with China, India, Iran, and others, positioning itself at the center of an alternative bloc. BRICS nations all benefit from multipolarity. Brazil, India, South Africa, and the new members gain leverage and autonomy. They can balance between the US, China, in Europe, rather than being trapped in dollar dependence. India's behavior during the Ukraine conflict exemplifies this new dynamic. India maintained relations with Russia despite American pressure, bought Russian oil at discounts, settled trades in rupees, and faced no serious consequences. This is the future for middle powers in a multipolar world. Gold wins enormously as countries lose confidence in fiat currencies controlled by politicized central banks. Gold purchases by monetary authorities are at 50-year highs and show no signs of slowing. Alternative payment systems, SIPs, SPFS, India's UPI, Brazil's PIX, and cryptocurrency networks all gain market share as countries diversify away from SWIFT. Financial technology companies in non-Western countries benefit from the shift away from dollar dominance. Who loses? The United States loses hegemony, not immediately and not catastrophically, but gradually and irreversibly. Dollar reserve status is the foundation of American power in the modern world. It enables unlimited deficit spending. It enables sanctions that actually work. It enables America to live far beyond its means. As that status fades, all these advantages disappear. America must balance its budget. The military becomes unaffordable without unlimited borrowing. Living standards fall relative to other countries. This doesn't mean America becomes poor, but it does mean America becomes normal. A large wealthy country, but no longer the hyperpower. Europe loses alongside the United States. European governments aligned themselves with American sanctions policy, joining the SWIFT disconnection and reserve freezing. This tied Europe to dollar system decline. The euro could theoretically replace the dollar, but Europe hasn't pursued that path aggressively. Instead, Europe followed American leadership. As the dollar declines, the yuan rises, not the euro. Europe risks becoming economically subordinate to both Washington and Beijing. SWIFT itself loses relevance. Though it's a Belgian company, SWIFT is perceived globally as a Western tool. As countries build alternatives, SWIFT's network effects weaken. SWIFT's business model depends on transaction fees. As volume shifts to CIPS and other systems, SWIFT's revenue and influence decline. Dollar holders face steady devaluation. Anyone holding dollar-denominated assets, treasury bonds, dollar bank accounts, dollar-based investments, faces persistent inflation as the currency loses purchasing power. Not hyperinflation or overnight collapse, but steady 5 to 10% annual devaluation relative to other currencies and hard assets. A treasury bond paying 4% interest while losing 7% to currency depreciation represents a negative real return. Investors will flee to alternatives, accelerating the dollar's decline. American consumers face the most immediate impact through reduced purchasing power and higher prices for imported goods that Americans have grown accustomed to buying cheaply. The timeline is now set in motion. The SWIFT weapon was deployed in February 2022. That deployment triggered the three-phase pattern we've observed throughout history. Phase 1, monopoly and trust, lasted from 1973 when SWIFT was created until 2022. That's 49 years of dollar SWIFT dominance. Phase 2, weaponization and shock, happened in 2022 with the Russia cutoff. We're currently in the early stages of Phase 3, diversification and decline. This phase will likely run for 15 to 25 years based on historical precedent and current data. By 2030, the dollar's reserve share will probably fall to 50%. By 2040, likely to 40% or below. The United States will still have the single largest currency, but no longer dominance. We're transitioning to a multipolar currency world, and the United States will be significantly weaker for it. Let me bring this to a conclusion. The SWIFT weapon appeared powerful in February 2022. Russia cut off, reserves frozen, maximum economic pressure applied. It seemed like the ultimate demonstration of American financial supremacy. But financial weapons function like nuclear weapons in one critical respect: you can only use them once. After you use them, everyone builds defenses and countermeasures. Russia built alternatives and survived. China accelerated SIPS development and yuan internationalization. BRICS expanded and began coordinating alternatives. The petrodollar monopoly broke. Central banks bought gold at unprecedented rates. Countries negotiated bilateral currency arrangements, and now the SWIFT weapon is effectively useless because any country the US might target in the future has either already built alternatives or is building them now in response to the Russian precedent. The United States could have maintained dollar dominance indefinitely through economic strength, open markets, and rule-based predictable policy. Instead, Washington chose financial weaponization, freezing sovereign reserves and cutting off major economies from global payment systems. This approach worked tactically against small isolated countries like Iran, but against Russia, it backfired spectacularly. And the backfire is systemic, affecting not just Russia but the entire global financial order. Britain weaponized finance in 1914 and lost reserve currency status by 1944. 30 years. The United States weaponized SWIFT in 2022. The historical pattern suggests dollar dominance ends by the early 2040s. Maybe sooner, because technology accelerates everything. This isn't prediction or speculation, it's pattern recognition based on historical precedent. Financial weapons always backfire against the power that wields them. The hegemon believes it's exercising ultimate leverage, but it's actually teaching the entire world to build alternatives. Once those alternatives reach critical mass, the original system loses its power. The SWIFT weapon destroyed SWIFT's monopoly. The dollar weapon destroyed dollar hegemony. The country that benefits most is China, the patient rival that watched America systematically destroy its own financial advantages without firing a shot. China didn't need to defeat America militarily. America defeated itself by weaponizing the tools of its own dominance. The three-phase pattern is playing out exactly as history predicts. The U.S. controlled SWIFT and the dollar for 50 years. The U.S. weaponized both against Russia in 2022. Russia found alternatives and survived. Over 50 countries are now hedging their exposure to dollar risk, and the weapon is rapidly losing its power. This is the end of dollar hegemony, not through military defeat or economic collapse, but through self-inflicted financial suicide. The SWIFT weapon worked once. It will never work again with the same effectiveness. The world learned the lesson: build alternatives, diversify away from dollars. Never be vulnerable to American financial weaponization again. If this analysis showed you something you didn't see before, if you understand now that financial weapons backfire on those who wield them, if you recognize that the SWIFT disconnection marked the beginning of dollar decline rather than the peak of dollar power, then you understand the next 2 decades of geopolitics. The dollar will decline, the yuan will rise, the world will be and the United States will be significantly weaker, not because of Chinese aggression or military conflict, but because of American policy choices. The United States possessed the golden goose of reserve currency status and strangled it with sanctions. This is the post-dollar world taking shape. It's not fully here yet, but it's coming faster than most people realize. The timeline is set. The pattern is clear. The SWIFT weapon was the trigger that started dollar decline. 20 years from now, economic historians will look back at February 2022 and identify that moment as when American financial dominance began its terminal phase. The decision-makers who deployed the SWIFT weapon simply didn't understand they were destroying the foundation of their own power. That's always how hegemony ends, not with enemies destroying you from outside, but with your own weapons turned against yourself. Thanks for watching Finance Folder. If you found this analysis valuable, make sure you're subscribed because we'll be tracking this story as it unfolds over the coming years. Hit that like button and share this with anyone who wants to understand where global finance is actually heading. The mainstream financial media won't tell you this story because it challenges too many assumptions about American power. But the data doesn't lie, and the pattern is unmistakable. See you in the next one.